Welcome back to another video here on the ComLucro channel. In this session, we are focusing on one of the most important yet misunderstood concepts within ICT and smart money concepts, the concept of daily bias. This framework helps traders understand directional intent by combining candle behavior with liquidity positioning, allowing for clearer and more objective bias formation. In this video, we will explain what daily bias is, how candle science works on the daily chart, and how internal range liquidity and external range liquidity interact to guide price movement. We will also walk through real market examples so you can see how these concepts align in live price action, and how to use them to build more precise, structured trade plans across lower time frames. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Understanding daily bias is one of the most important skills a trader can develop. It is often described as one of the most complicated ICT concepts, but in reality, it is very, very simple once you know what to look for. All you need to do is clearly understand these two concepts, and once you do, everything starts to make sense. The first one is the concept of candle science, and the second one is the concept of internal range liquidity through external range liquidity. So now let's break them down and go through them one by one. When I talk about candle science, these are the 4 candles I am referring to. Now let me explain each of them step by step. Let's assume that this is a daily chart. Here we can see that the first candle is bullish. Then the second candle pushes higher and closes above the high of the first candle. This tells us that we should be anticipating bullishness on the third day, at least expecting price to take out the previous daily high. Now this also means that if price continues to close above the highs of the previous candles, then we should continue to maintain a bullish bias. But if price pushes up and suddenly is not able to close above the high of the previous candle, that now tells us something has changed. In that situation, we should start looking for sell opportunities, at least until price reaches the previous daily low. Now the same logic applies in a bearish scenario as well. When price closes below the previous daily candle, we should be anticipating sell-side movement. But when price attempts to close below that level and instead ends up closing back above it, then we should start anticipating bullishness. So here, these are the 2 bullish scenarios where we should begin expecting higher prices. And these are the 2 bearish scenarios where we should start anticipating lower prices. Since we now understand candle science, the second way to simplify and understand daily bias is by using the concept of internal range liquidity to external range liquidity. This is honestly the concept that completely changed the way I look at the market. It has 2 clear components: internal range liquidity and external range liquidity. Internal range liquidity, also known as IRL, refers to fair value gaps within price. External range liquidity, on the other hand, refers to swing highs and swing lows on the chart. Now, the concept of internal range liquidity to external range liquidity states that when price is trading at an internal range liquidity, it has a high probability of moving toward the external range liquidity. And if price has just taken out an external range liquidity, then it will most likely start seeking an internal range liquidity next. Let me illustrate this with a chart so it becomes clearer. Here you can see that price left behind a fair value gap, which represents our internal range liquidity. Once price returns to that area, we should start expecting the newly formed external range liquidity to get taken out. And as you can see here, price does exactly that and takes out the external range liquidity. So the next logical expectation is for price to come back into an internal range liquidity before continuing and targeting the next external range liquidity. This is how price moves most of the time when it's behaving efficiently. However, you should also keep in mind that price does not always move this cleanly in every situation. There will be noise and variations. Still, this is the core idea and the basic framework of how this concept works. Now, you can take this a step further by combining internal range liquidity to external range liquidity with candle science to gain better precision when it comes to defining bias. Here's what I mean. In this example, we have an internal range liquidity and price has now returned back into it. At this point, we wait for price to sweep and close below the previous candle's high. And here you can see that price does exactly that. Now you can confidently drop down to the lower time frame to look for trade entries, because you already know that when price reaches an IRL, there is a very high probability that it will move toward the ERL. But now that IRL is also aligned with candle science, we have what you could call a double layer of confluence. Because of that, you can simply move down to your lower time frame and focus on finding clean, well-structured entries. Now let us look at a live example so everything becomes more practical. Here you can see the current Euro to US dollar daily chart, and I can clearly identify two areas where price aligned both internal range liquidity to external range liquidity and candle science at the same time. These are the two areas. Notice how price moved into the internal range liquidity, then swept below the previous candle's low in the first example, and swept the previous candle's high in the second example before continuing its move toward the external range liquidity. This is exactly the behavior we are looking for. Now let us focus on the first example only, so we can clearly see how we could have taken advantage of that move. First of all, we can see that price is trading at an internal range liquidity, and it has just swept the previous candle's low, which is a clear bullish indication. Based on that, our objective and target will be set at the external range liquidity. Now, taking the trade directly from this level, especially on the daily chart, would not be ideal, because it would not offer a favorable risk-to-reward ratio. Because of that, it makes much more sense to move down to a lower time frame. And since our analysis is coming from the daily chart, the most appropriate and ideal time frame for entries in this case would be the 1 hour chart. Now, as we move down to the 1 hour chart, almost immediately we can spot a clear liquidity sweep followed by an impulsive move to the upside. This move breaks multiple structures and leaves behind a series of fair value gaps. At the same time, when price breaks structure, it also creates a breaker block, which aligns perfectly with one of those fair value gaps. This gives us a very clear point of interest. This would be the ideal area to place a limit order, set the stop loss just below the fair value gap, and define the take profit at the external range liquidity. And as you can see, price taps directly into our point of interest and then moves straight to take profit. Before we wrap this up, it is important to understand that daily bias, liquidity, and candle behavior are all part of a broader smart money framework built around structure and directional intent. The same logic carries over into models like the CSS model, also known as candle sweep SMT, where price reveals direction through specific candle behavior and liquidity interaction. To reinforce what you've learned in this video, let's take a quick look at how this concept plays out in real market conditions and how candle sweeps align perfectly with the daily bias framework. Now, when price takes out the high of a candle and then closes back below it, or when price takes out a low and then closes back above it, this is what we call a candle sweep. A candle sweep SMT occurs when price moves above the previous candle's high and then closes back below it, while the correlated pair does not replicate that move. In other words, one pair sweeps the high and closes below it, but the other pair does not even reach that level. This divergence is what we define as a candle sweep SMT, and it is extremely powerful, especially when it forms inside an internal range liquidity that aligns with market bias, particularly when it also agrees with the higher time frame bias. Let's assume this is the Euro-US dollar chart. On the daily time frame, we are expecting higher prices the following day. We then drop down to the 4-hour chart and notice that price is sitting inside a 4-hour bullish internal range liquidity. While price remains within that 4-hour internal range liquidity, we observe a candle sweep, meaning price attempts to move lower but fails to close below the previous candle's low. Now, since this is the Euro-US dollar chart, we shift our focus to the British pound US dollar chart. If we see that the British pound US dollar does not sweep the previous candle's low, that divergence gives us our candle sweep SMT. This is the zone where we should begin looking for an entry, with the target set at external range liquidity. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.